Rate cuts, rate cuts, rate cuts. Looks like it's happening, folks. Cue the real estate bull market and 100% increase in home values. I'm kidding, of course, but the question now becomes what will happen over the next 6 months as the Bank of Canada becomes the very first central bank to cut rates after this historic rate hike cycle, raising rates from COVID lows at 0.25% at the low, all the way up to around 5% for the Bank of Canada's overnight rate. You're joining me here live. We're going to be watching the Bank of Canada's media availability after they've just announced this 0.25% rate cut. That's 25 basis points in fancy economist language. But yeah, a quarter of a percentage point lowered, going to have an impact on mortgage rates, going to have an impact on a lot of different things across the economy. Of course, the Bank of Canada's high rates were designed to ease inflation, bring down inflation, which they now believe clearly that they have, at least enough for the meantime. Big question here is, have they done enough? Have they done too much? These are the questions that we're hoping to answer in this press conference. Let me show you what I'm looking at here. We've got the Bank of Canada just starting their press conference. I think we're going to dive in right here. Thanks for joining me. Let me know that you're here. Leave a comment and let's get into this. And at the end, we'll do a little bit of Q&A, a little bit of analysis of what has gone on here, what's surprising, what's not so surprising. But let's dive into it. Thanks for joining me, folks.
My name is Paul Bodicher. I'm the Director of Media Relations here at the Bank of Canada, and I'll be moderating this press conference about today's interest rate announcement. Comme d'habitude, le gouverneur Macklem va prononcer une brève déclaration préliminaire et après ça, on va tourner aux questions. After his opening statement, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions. And so with that, I will turn it over to Governor Macklem for his opening remarks. À vous la parole.
Thank you. Good morning. Senior Deputy Governor and I are very pleased to join you for this morning's policy announcement. The Governing Council decided monetary policy no longer needs to be as restrictive and lowered the policy rate by 25 basis points to 4.75%. We've come a long way in the fight against inflation, and our confidence that inflation will continue to move closer to the 2% target has increased in recent months. The considerable progress we've made restoring price stability is welcome news for Canadians. Since our monetary policy report in April, underlying inflation has continued to ease and economic growth has resumed. With the economy in excess supply, there is room for growth even as inflation continues to ease. Le Conseil de direction a convenu que la politique monétaire n'a plus besoin d'être aussi restrictive. Il a donc baissé le taux directeur de 25 points de base pour l'établir à 4,75%. On a fait beaucoup de progrès dans la lutte contre l'inflation. Et notre confiance que l'inflation va continuer vers la cible de 2% s'est renforcée ces derniers mois. On a fait de grands progrès pour établir.
If you're just joining us here, the Bank of Canada announcing 0.25% rate cut, likely to make another rate cut in September would be my guess at their next sort of scheduled rate announcement.
Et la croissance économique.
Largely, I think this 0.25% cut isn't going to do a whole lot, but it is more of a directional signaling, right? The Bank of Canada seems like they're now comfortable with going on a cutting cycle. Let's listen in.
In the second half of last year, economic growth picked up in the first quarter of this year. At 1.7%, growth was lower than projected in the April report. But consumption growth was solid at about 3%, and business investment and housing activity also increased. In the labor market, businesses are continuing to hire workers. Employment has been growing, but at a slower pace than the working age population. This has allowed the supply of workers to catch up with job vacancies. Elevated wage pressures look to be moderating gradually. Inflation remains above the 2% target, and shelter price inflation is high. But total CPI inflation has declined consistently over the course of this year, and indicators of underlying inflation increasingly point to sustained easing. I'll highlight 4 indicators in particular. CPI inflation has eased from 3.4% in December to 2.7% in April. Our preferred measures of core inflation have come down from about 3.5% last December to about 2.75% in April. The 3-month rates of core inflation slowed from about 3.5% in December to under 2% in March and April. And the proportion of CPI components increasing faster than 3% is now close to its historical average, suggesting price increases are no longer unusually broad-based. This all means restrictive monetary policy is working to relieve price pressures. And with further and more sustained evidence underlying inflation is easing, monetary policy no longer needs to be as restrictive. In other words, it's appropriate to lower our policy interest rate. Si l'inflation continue à ralentir et que les données continuent à renforcer notre confiance qu'elle se
So
dirige.
interesting stuff here. As he's speaking French here, I'm going to do a little bit of commentary. I'm listening in, and we'll join back in as he gets back to English. For my English viewers here, he paints a really rosy picture of the economy, despite the interest rate cut coming. Usually you're looking for these sort of negative economic indicators to say, okay, maybe we've gone too far, we should cut rates a little bit. But he paints a pretty rosy picture and talks about how great it is that wage pressures are down. There's more people than jobs, and as a result, businesses don't have to pay their employees as much. We can talk a little bit about whether or not this is a good thing or a bad thing en masse, but for the Bank of Canada, in his view, he's thinking, okay, businesses have lower inputs or lower costs, right? Because they have to pay their employees less because there's more workers than there are jobs. This wage price pressure isn't as great as it was before. And okay, maybe now we can lower rates a little bit.
Inflation is headed sustainably to the 2% target, continues to increase. It is reasonable to expect further cuts in our policy interest rate.
Wow.
But we are taking our interest rate decisions one meeting at a time. We don't want monetary policy to be more restrictive than it needs to be to get inflation back to target. But if we lower our policy rate too quickly, we could jeopardize the hard-won progress we've made. Further progress in bringing inflation down is likely to be uneven and risks remain. Inflation could be higher if global tensions escalate, if house prices in Canada rise faster than expected, or if wage growth remains high relative to productivity. In assessing where inflation is headed, we will continue to closely watch the evolution of core inflation. We remain focused on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. With that summary, the Senior Deputy Governor and I will be very pleased to take your questions. Thank you.
Okay, thank you, Governor. Let's just quickly go over the ground rules.
Wow. So just before we get into these questions here, this is usually where we get the juiciest stuff when the reporters have a chance to ask the governor and deputy governor of the Bank of Canada here, well, what's going on? Some interesting stuff that he says there. Hey, we actually think it's reasonable for you and everybody to assume that there will be more rate cuts in the future. This is a bigger pivot than I expected, honestly, from the Bank of Canada, who uses one tool, their interest rates, to control the economy, but another tool, which is the words they say. What they tell us they're going to do in the future is another way of making people act in a certain way based on those assumptions, right? We heard the Bank of Canada at the beginning of the pandemic say, don't worry, rates will be low for long, because they wanted to have people spend and do all these things. Over the past number of months, they've been saying, okay, we're not there yet, we're not there yet, we're not there yet. We're not going to signal that we're there yet for rate cuts because we don't want to risk inflation coming back and people starting to act like there will be rate cuts, which is why this is such a big pivot, right? We've got the Bank of Canada saying, not only are we cutting rates, but our forward guidance now is that we are going to continue to cut rates, although they do sort of have the caveat there saying we are taking it on a case-by-case basis from announcement to announcement, even though he says you can it's reasonable to expect rate cuts. He says, hey, we still have an out here if we see wage prices or wage pressures continue to to go back up, and then that could be an issue. If we see inflation increase due to maybe global pressures, uncertainty in terms of different wars and things across the world, he says that could be something that makes us raise rates again or at least hold them. But he says this is a big pivot. We're starting to cut rates here. Also interesting that he says if housing starts to boom again with this rate cut, well, then they could reevaluate. This made me think it's kind of odd how they sort of selectively look at real estate when they want to sort of justify doing different things. Like, weren't looking at real estate a whole lot while they kept rates low during the pandemic when they weren't seeing CPI inflation, but they were seeing asset price inflation. So interesting that they weren't looking at real estate then, but it seems like they might now, in evidence to support maybe not lowering rates as quickly. But interesting stuff. Yeah, let's get into these questions because this is where more of the juicy stuff comes, the stuff that they haven't prepared, perhaps more pointed questions about their decisions.
We're going to start here in the room in Ottawa and then go to the phones. I've got quite a long list, so let's limit it to one question, please, per outlet. If I forget to do so, please state your name and affiliation. For those who are new here in the room, please press the green button on the little box in front of you to activate your microphone. Press it again to shut it off once you've done asking your question. Avant de poser une question, veuillez vous identifier et si je ne l'ai pas fait. Et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. With that, let's start here in the room. I'm going to start up here up front with Jordan Gowling from CTV, please.
You previously said that you won't be cutting rates at the rate that you raise them. Does this mean Canadians should not expect a cut next month, or do you plan to cut again in July?
Look, I think the message was pretty clear. We're going to be taking our interest rate decisions one meeting at a time. If the economy continues to evolve broadly as we had expected, if we continue to see inflation pressures easing, it is reasonable to expect that there will be further cuts in interest rates. But the timing of those cuts, or of any further cuts, are going to depend on incoming data and our assessment of what those data mean for the future path of inflation. Look, we are determined to get inflation back to the 2% target. At 2.7%, we're still above target. There are a number of risks that we're watching closely. So, the work's not done. We're going to be seeing how things evolve and taking our decisions one meeting at a time.
Let's go now to Promit Mukherjee from Reuters, please.
Thanks, Paul. Hi, Mr. Governor. I would like to again take it forward, that question. Considering that so far the data has shown that the inflation has been easing and it's going in the trajectory that you wanted. If it continues in that way, and you will have more numbers in terms of GDP and job by July 24th, if that all continues the way you want it, do we see a rate cut in July?
I'll get to the going ahead, but let's just enjoy the moment for a bit. Let me just say a couple of key points about the rate decision today, and then I will come back to where we could be headed. But look, a couple key messages today. We've come a long way in the fight against inflation. Headline inflation has come down, our measures of underlying inflation have been easing, and growth has resumed again in the Canadian economy. Second key point is the economy has evolved broadly the economy has evolved broadly as we've expected in recent months, and that has increased our confidence that inflation will continue to move gradually back closer to the 2% target. So we decided at this meeting that monetary policy doesn't need to be as restrictive as it has been. And we lowered the policy rate by a quarter point. I know this is welcome news to many Canadians. I also know everybody wants to know, okay, where are we headed? That is going to depend how things evolve. What I can say is that if the economy continues to evolve broadly as we expect, and we continue to see a broad easing in inflationary pressures, it is reasonable to expect further cuts in our policy rate. But, and I want to stress this, the timing of any further cuts is going to depend on incoming data. In particular, is going to depend on what those incoming data tell us about the most likely future path for inflation. We are determined to get inflation back to the 2% target. We know there can be some bumps along the way. There are a number of risks, which I highlighted in the opening statement, which we're watching closely. So what does all that mean? It means we're going to be taking it one meeting at a time.
Paul Vieira from the Wall Street Journal, please.
In testimony to lawmakers last month, you talked about how if there's going to be rate cuts, they would be done gradually, and you talked about that there are limits to Fed policy divergence. Why is the word gradually or cautiously in terms of describing further cuts? Why is that absent from the statement?
I think we're being pretty clear. We're going to take it one meeting at a time. When I was asked about the pace of cuts, I think the question was something along the lines, you raised rates very rapidly. What's the pace of cutting looked like? When we raised rates rapidly, we were in the situation where inflation had moved up very rapidly, and we needed to raise rates rapidly to control inflation and bring it down. The situation now is quite different, and our own forecast has inflation easing gradually back towards the 2% target. So what that suggests is that the future path of interest rates, while it's reasonable to expect further cuts if inflation continues to ease, given that it's likely to ease gradually, the path for interest rates likely to be gradual.
Let's go to Kevin Carmichael from The Logic, please.
Governor, you, the Senior Deputy Governor, others at the Bank of Canada have been obviously doing a lot of work around the productivity crisis. You seem to have surrounded the lack of investment as one of the big issues behind that problem. To what extent has the higher for longer interest rate environment impeded investment in your view, and how will that factor into your decision on how quickly to bring down rates going forward?
Well, Kevin, as you know, the productivity problem we've had here is long-standing, has multiple factors. It's had multiple factors contributing to it. It'll take more than one thing to solve it. Interest rates, certainly right now, interest rates and inflation are both uncertainty factors that affect business investments. So, as we get inflation back to target, that'll remove that uncertainty. Interest rates, as the governor said, it's welcome news. We've been able to lower interest rates today. We'll take the next decisions as they come and see how that factors into investment.
Okay, let's come down here to Najud Al-Malez from Canadian Press, please.
Hi, Governor. Building on Paul's question about the limit on how much Canada can diverge from other countries in terms of interest rates, can you talk a little bit about what that limit looks like and what it means for Canada right now to be diverging from many of its peer countries?
So in Canada, we have our own currency. We have a flexible exchange rate. And what that means is that we can gear monetary policy to the needs of the Canadian economy. So we don't need to move lock and step with the Federal Reserve. Obviously, what happens in the United States has a big impact on our economy. The U.S. is the biggest source of Canadian imports. It's a major source of, it's a biggest source of Canadian exports. We also import a lot from the United States. Our financial markets are very integrated. So what happens in the United States certainly has an impact on Canada, and we take that into account when we develop our own forecasts, our own outlook. We take that into account when we take our monetary policy decisions. But we have our own currency, we have a flexible exchange rate, so that means that we can take decisions that are geared to what the Canadian economy needs. And our judgment today is that the Canadian economy doesn't need monetary policy as restrictive as it has been, and so we cut the policy rate by 25 basis points. There are limits to how far we can diverge from the United States, but we're not close to those limits, and I expect that we will continue to be able to get inflation back to target and run monetary policy in Canada within those.
Interesting stuff talking about divergence from the Federal Reserve in the States. Obviously, they haven't started cutting yet, but the Bank of Canada now has started cutting ahead of it. A couple questions there in terms of the value of the Canadian dollar. Usually people say when rates are lower in one country than another country, and that tends to devalue the dollar, and the country that has the lower rates has all kinds of ramifications for imports and exports. Sometimes people think that, okay, maybe it helps our exports because people can buy it at a cheaper price if the Canadian dollar is lower. So that's kind of what they're talking about here. But he says, okay, we can do our own monetary policy based on the Canadian economy here. So that's why it's okay for us to start cutting rates. Another important thing to think about is I believe personally that the monetary policy of the Bank of Canada has a bigger impact on Canadians than the monetary policy of the Federal Reserve does on Americans when it comes to average citizens, largely because of the way the mortgages work in the country. In Canada, everybody has to renew every 5 years. That's the standard, right? So the impact of the monetary policy in Canada has a larger impact. People feel more poor as they sort of see their mortgages go up. Whereas in the States, if the Federal Reserve raises rates, well, then everyone who's locked in on a 30-year mortgage, they don't have to renew. It doesn't impact them as broadly. It more impacts people and businesses that take on debt rather than individual consumers. So I think that's why we're seeing here the Bank of Canada start off a little bit earlier. And appreciate it. Candace from Mountain Finance, a great channel, gifted one membership to the channel. I appreciate it, Candace. W's in the chat for Candace. Let's keep on going.
Okay, next on my list I have Alicia Sikirska from Yahoo Finance. Please go ahead.
Thank you, Governor, for taking our questions. Can you take us through the bank's consideration in weighing this cut versus the potential risk it may have on the housing market and in accelerating shelter prices?
When we published our April monetary policy report, we were expecting some modest increase in house prices. That was ahead of this decision. We did then, and we continue to point out housing as a risk to our inflation forecast. So it's something we're going to continue to watch. Ultimately, what we target is inflation. We don't target any particular measure in the housing market or an interest rate, but it's clear there is some pent-up demand in the housing market. We'll see how it goes.
Okay, I'm going to come down here now to Mackenzie Gray from Global, please.
In the same vein on housing, 76% of Canadian mortgages are going to be up by 2026. How much does that play a decision when you're thinking about cutting or keeping rates where they are? And how concerned are you that broadly for an impact on the Canadian economy?
Yeah, I mean, we're talking a lot about the data that we look at when we make our decisions. We always look at how our decisions are going to affect Canadians, and certainly the mortgage market is a big part of that. Mortgages are one of the biggest interest sensitivities that Canadians have. So we're looking at the same data. The 76% is a number that OSFI put out. That's something we've been watching all along. We did a deep dive on this just a few weeks ago when we put out our financial stability report. And you'll remember in that report, we also pointed out the impact on renters. So, we know people holding mortgages are feeling the squeeze. We know there is concern about higher interest rates when they renew their mortgage. But the effect of the credit stress we see is also showing up in renters too. And, that's really inflation as well as interest rates showing up. So, what we can do to help that situation is get inflation back to target. We know Canadians with mortgages that are renewing will welcome this interest rate change. They would like to see further changes, further reductions in interest rate. As the governor said, it's reasonable to expect that if the economy continues to evolve as we expect it to, if we continue to see an easing in core and headline inflation. But the bottom line is we also need to get inflation back to target. We're determined to do that.
Okay, Randy Thantong-Knight from Bloomberg, please.
Hi, Governor. How concerned are you that slower population growth will change your assumptions for potential growth, and how does that affect your thinking?
We are expecting population growth to slow. It has been exceptionally strong. The government has announced a number of measures, particularly to slow the number of non-permanent residents coming into Canada. We built that into our April forecast. That announcement came out before the April forecast, so we have built in that path for population growth. Population growth affects both demand and supply in the economy. Obviously, if you've got more people coming into the economy, you've got more workers, they're adding to the labor force. That has eased the tightness we've seen in the labor market. Those newcomers to Canada, though, they also need to rent apartments. They need housing. That has put a lot of pressure on the housing market. So there are both demand and supply effects. As population slows, that should, and if the supply of housing can increase as demand comes down, that should help relieve some of the pressures we've seen in the labor market, in the housing market. And with the labor market coming into better balance, we've seen businesses are hiring. They're still hiring, but their hiring has slowed, and it's actually below population growth now, which has helped rebalance the labor market. But the labor market is reasonably balanced. So. We will be watching population growth carefully, and when we get to our July forecast, we will update our assumptions about population growth and feed that into our projection. But given that it affects both demand and supply, it's not going to probably swing the forecast dramatically.
I don't fully buy this whole supply and demand being equal parts of when we see high population growth. I get what he's saying. More people working will create more goods, and that's more supply, and there's more wage supply for businesses as well, reducing input costs for businesses. But I think that the demand shows up a lot more quickly than that sort of lagging supply difference. So the population comments here, I still don't really buy into that narrative that he's been pushing for quite a while, that it doesn't make a difference. And I'm also not entirely certain that these changes to the immigration policy in Canada are actually going to slow down population growth as much as we think. I think there's going to be a little bit of a slowdown from the international student changes, but we see Mark Miller in the government sort of coming up with these new plans to bring in more people who are caretakers into Canada. I ultimately think that the Canadian government knows that we need to bring in, or they think we need to bring in as many people as possible because of the demographic challenges over the next 20 years. But does that actually help average Canadians, or does it help the numbers that businesses and governments look at to make themselves feel like they're doing a good job without actually helping individuals, right? These numbers don't often serve individuals, they serve the wealthy and corporate elite, I think.
Okay, next on my list I have Mark Rendell from the Globe and Mail. Please go ahead, Mark.
Thanks for taking the question. I'm wondering if you can talk a little bit about the trajectory you see for the economy over the next coming quarters, next year or so. Obviously, as was mentioned before, we have a lot of mortgage resets, quite sizable mortgage resets and payment shocks coming up. Are we through the worst of it? Is there still a possibility for a recession going forward?
Well, as you know, we don't have an updated forecast at this policy decision. We run our forecast 4 times a year with the national accounts. We will have a new forecast in July. But we did receive, obviously, the national accounts for the first quarter recently. And so growth in the first quarter at 1.7% was weaker than we'd forecast in our April monetary policy report. At the time, we forecast 2.8%. I guess what I would stress is that if you look at last year, certainly the second half of last year, the economy was really quite weak. GDP growth roughly zero through the second half. On per capita terms, consumption was actually declining. In other words, households were reducing, individual households were reducing their spending. In the fourth quarter and in the first quarter, consumption growth was about 3%. It's broadly in line with population growth. So what that means is that, per capita basis, consumption was roughly flat. So you're seeing some strengthening in consumption growth. In the first quarter, you also saw investment picked up a bit. Housing market has not been particularly strong, but it was positive. So growth has resumed in the first quarter. We'll certainly be looking at our growth trajectory going forward. But, to get back to your soft landing question, yes, so far it is looking like a soft landing. The plane hasn't been landed yet, so we're not cheering yet. But, I would say the runway's in sight. But, we still need to land this.
Okay, Greg Quinn from Market News. You're next, please.
Good morning. I want to ask about growth in the other sense, because the statement mentions the idea that there's room for growth in the economy even when inflation slows. I mean, that's a nice scenario. How big is that crawl space? Do we have a substantial amount of room to grow from here without sparking new inflation pressure?
Well, to go back to the previous question, so with growth roughly zero in the second half of last year, excess supply opened up in the economy. And that's actually been key to relieving price pressures, has been an important reason why we're seeing inflation and underlying inflation come down. With some excess supply in the economy, what that means is there's room for the economy to grow. In fact, there's even room for the economy to grow faster than potential for a period, even as there is still downward pressure on inflation. So, we will be revising our forecast in July. I don't have a new forecast for you today, but I think what we're seeing in the first quarter, our growth has resumed. I think we expect over the course of the year, we expect household spending to gradually strengthen. And our message really is, given that the economy is in excess supply, there is room for the economy to grow, even as inflation keeps coming back down closer to the target. And, so to get back to our decision today, why did we conclude that monetary policy doesn't need to be as restrictive? Well, an important reason is just looking at inflation itself, core inflation, our various measures of underlying inflation. Since the start of the year, they've all been moving in the right direction. The fact that the economy is in excess supply, though, is another element that is giving us confidence that, even as the economy, even as growth resumes, inflation can keep moving back towards the 2% target.
Okay, our final question in the room here goes to Daiichi Mishima from Nikkei News Service.
This is Daiichi Mishima with the Nikkei. Thank you for taking our questions, Governor Macklem. While you decided to cut rates, you also decided to continue quantitative tightening. It seems to me that you're stepping on the gas and brake pedals at the same time. So how do you determine when to stop QT? What are the conditions for that? Thank you.
Well, I don't see it quite the way you see it. The way we see it is we're normalizing our balance sheet. And as long as let me put it, we've gone through this before, but I'll go through it again. Yes, we reduced our policy rate today by 25 basis points, but at the policy rate of 4 3/4, monetary policy remains restrictive. And in fact, with inflation at 2.7%, underlying inflation roughly 2.75%, we still need restrictive monetary policy. There is still some work to do to get inflation back to target. It doesn't need to be as restrictive, but we still need restrictive monetary policy. And in that sense, continuing QT, continuing to normalize our balance sheet makes sense. If we were to lower interest rates so much that we're actually trying to provide stimulus to the economy, that would be a different situation. And in that situation, we probably would stop QT because, and then they would be working at cross purposes. But that's not the situation we're in now. With respect to the path for our balance sheet going forward, we have been letting maturing bonds roll off our balance sheet. Our balance sheet has been steadily shrinking. We will get to a point where our balance sheet is normalized, and at that point we will resume our normal operations and NQT resume normal operations and begin buying government debt once again. As Tony Gravel has outlined certainly in speeches, that'll probably happen sometime next year. And we will provide, as we get closer to that point, there is some uncertainty exactly where that point's going to be. As we start to get closer to that, as we hone in on what the steady state level of settlement balances needs to be, we will provide markets update on that.
Interesting stuff there around QT, quantitative tightening, which we'll talk about in just a second. And thank you to Marco Peruza for the super chat saying, yes, my real estate portfolio gets saved. Time to take out more HELOCs and screw first-time home buyers. A little bit of tongue-in-cheek there, I think, from Marco. I love India and Canada. Yes, Canada, a nation addicted to real estate and politicians who are addicted to saying they're going to do something about affordability, but not actually doing it, because all they need to do to get the votes is to say they're going to do it. And if you don't actually do anything, then you keep all the voters happy who do have homes already. So that's wild. So we hear here the Bank of Canada, Tiff Macklem specifically, talking about quantitative tightening. Is the fact that you are lowering interest rates and continuing to not repurchase bonds that are on your balance sheet, are those working at odds? The quantitative tightening, of course, is the sort of opposite of quantitative easing, where the Bank of Canada bought a whole bunch of Government of Canada bonds to try to lower interest rates even more so by increasing the demand for bonds, thus lowering the interest rates on those bonds. Now, the Bank of Canada, over the past maybe a year or so, has been doing QT, not actively selling the bonds that they already purchased, but not renewing them when they come up. So not repurchasing bonds, and this again is a sort of tightening effect on the economy, in that there's not additional demand in the bond market pushing rates down. Instead, there's less demand than if the Bank of Canada were in there, and it keeps rates a little bit higher. So interesting stuff here.
Okay, that's it for the room. We're going to go to those reporters who have joined us remotely. I'm going to just remind people on the line, please come off mute only to ask your question, then go back on mute as soon as you have finished so everyone can hear the response. I'm going to start with John Ehrlichman from Bloomberg BNN. John, please go ahead.
Thanks so much. Governor, I just wanted to see if you could shed some light on how you think about the level of our dollar, the currency, the relationship with the U.S. currency, and this idea of us importing inflation if we see more weakness in the loonie. And also, since you haven't been asked and the senior deputy governor haven't been asked about your pin so far, what happens to the Canadian economy if the Edmonton Oilers win the Stanley Cup?
Well, let's hope. Canadian team, let's hope the Oilers win the Stanley Cup. Go Oilers. The Canadian dollar. I mean, as I said previously, we have a flexible exchange rate. And one of the ways monetary policy works is it works through the flexible exchange rate. And it's the flexible exchange rate that gives us the ability to set interest rates in Canada that are geared to the needs of the Canadian economy. So, we don't have a target for the exchange rate. We have a target for inflation. We believe in flexible exchange rates. And I think by being clear about our forecast, be clear about what's on our mind, by doing these press conferences, by publishing the monetary policy report, by providing a summary of deliberations. I think markets have a very good idea what's on our mind, and that's going to be reflected in the expected future interest rates. That's going to be expected in the exchange rate. That's monetary policy working.
Okay, next on the list, I've got Max Sato from Mace News. Max, please go ahead.
Thank you, Paul. Governor, leading up to today's rate cut decision, was there any discussion among the governing council members as to how this could affect the value of the Canadian dollar and the import costs, or how the policy difference with other major central banks could affect the real economy?
It seems like people don't listen to the previous
we
answers.
discussed all those things. Of course we did. As I said, with respect to the exchange rate, it's one of the ways monetary policy works. And yes, we have been assessing the impact of higher interest rates on Canadian households, on Canadian businesses, and we know it's been difficult. We know it's squeezed households and businesses. That has relieved price pressures in Canada, and we came to the conclusion of this meeting that monetary policy doesn't need to be as restrictive as it has been. So we lowered the policy rate. So yes, those are the things that we're looking at.
Maybe I'll add, if you think about this past run-up in inflation, in the early days, a lot of what was going on was global. So there was commodity prices, there was supply chain impacts. And so central banks across the globe were acting sort of in concert. We were doing the same thing because we were seeing the same things, we were dealing with the same thing. As inflation's come down, what is remaining for most of us is really more about what's in our domestic economies. And so it's logical that we're going to diverge a bit, because what we're doing is responding to what's in our domestic economy, and that's different. And it's different for a variety of reasons that the governor's mentioned. It's different because monetary policy is working a bit differently in each economy. There's different factors. So although we were quite coordinated on the way up, and that was really helpful because a big part of inflation was global, you're going to see some divergence on the way down, and that makes sense.
Okay, next I've got Rob McClister from Mortgage Logic News. Go ahead, Rob.
Good morning. I'm wondering how Canadians should view the bank's estimated neutral rate now that we've pivoted to an easing cycle. So, in other words, if inflation evolves as the Bank of Canada projects and drops back to 2%, is it reasonable to expect the overnight rate should get close to the bank's estimated
This is a good question. This is like, where will rates
okay,
be
well, the
ultimately?
first thing I need to tell you is I don't think Canadians should spend a lot of time thinking about the neutral rate. The neutral rate it's a theoretical concept. It's something we need in our models. The neutral rate is, where the policy rate would settle in the long run when the output gap is closed, inflation is back to target, and there are no new shocks. In other words, we'll never get there. There's always going to be new shocks. There's always going to be new events. The interest rate is the thing that we adjust to get inflation back to target and to keep it there. Now we do need an estimate of the neutral rate. We can't observe the neutral rate, obviously, directly. We do need to put an estimate of the neutral rate in our models. And in the spirit of transparency, we publish our estimate of the neutral rate. We updated our estimate in our last monetary policy report in April, and we increased the neutral rate estimate by 25 basis points, or we have a range. The midpoint of the range is 275. Look, I know, talk of the terminal rate, the neutral rate, I really think you're getting ahead of yourselves. If you want to know where we're headed to 2% inflation. And the interest rates are going to be what they need to be to get us there and keep us there. As we've said, look, in the near term, if the economy continues to evolve broadly as we expect, if we continue to see inflationary pressures ease, it is reasonable to expect further cuts in our policy rate. But the timing is very much going to depend on incoming data and our assessment of what that means for the path for inflation. When you look out beyond that, I mean, we don't have a crystal ball. But what we have said a few times in the past is that if you look at where interest rates were after the global financial crisis and before COVID hit, it was at a period of unusually low interest rates. When you look at that today, a number of the forces that resulted in those very low interest rates look to be unwinding. So, we don't have a crystal ball, but it does seem likely that interest rates, while we do expect they're going to come down, they're probably not going to come down as low as they were pre-COVID. Or to put it another way, it would be prudent for households and businesses and governments not to plan on interest rates getting back to pre-COVID levels.
That's interesting. So he's saying essentially the only way that we could get back down to COVID level rates or even pre-COVID level rates is if they need a lot of fiscal stimulus, a financial stimulus. Like if there's some sort of black swan event, something bad happens, economies have to shut down again, or there's something that, some sort of big event, then they'll bring down rates even more. But he's saying, okay, maybe we're only going to get to like 4% this time, and maybe that's like a more reasonable rate to sort of float at over the long term than the like 2.75, 3% pre-COVID rates that were around. It's interesting stuff to look at. Yeah, I think that one of the things is he's saying, okay, over over this long period of time, there were a lot of things that allowed us to have rates so low because we didn't see a lot of inflation in products that we got. I think that's largely due to the globalization trend, right? We have better relationships with China. We're able to produce goods more cheaply, so inflation isn't raising as fast as it otherwise would. Now we're seeing largely a reversal of that trend, less and less global supply chains, more friend-shoring or reshoring, that I think is the buzzword around that. So that could be a longer-term higher price pressure on those goods and services because, we're not able to produce it as cheaply as we once were.
Okay, and our final question goes to Barbara Schechter from the Financial Post.
Hello, thanks for taking the call, or the question. I wanted to ask if you've modeled how far you can diverge from the Fed. Your financial stability report.
Just keep asking the same question. Like, listen to the goddamn
markets. You've obviously looked at that.
Answers.
So how far can you diverge before it starts to flow into problems with the currency and markets like the bond market, that kind of thing?
Well, I think you can. You can look over history and see how much we have diverged at various times in the past, and give you some guideline. As I said, we're not close to that. I think the market, as a senior deputy governor just indicated, conditions are somewhat different in Canada and the United States. Inflation has been easing consistently in Canada. It's been stickier in the United States. U.S. economy has been stronger. Conditions are different. I think markets are seeing that. And that's been built into our rate expectations. It's certainly something that factored into our decision. And I think markets will continue to absorb the incoming information. So I don't think we're close to that limit. I don't think it's like there's no sort of bright line. And you can see from history there have been periods of considerable divergence.
And with that will conclude today's press conference. Thank you, Governor, Senior Deputy Governor, and thank you, everyone, for joining us. We'll see you in a few weeks.
So there we have it, folks. If you are just joining in, we've been covering the Bank of Canada and their recent rate cut announcement. Just as of this morning, they announced that they're bringing their overnight rate from 5% down to 4.75%. That's a quarter percentage drop at 25 basis points, many will refer to it as. What impact this will have on the economy, it remains to be seen. Just how impactful this will be. I think it's more interesting in terms of a signaling of their comfort to go in the rate cut direction, more so than any one individual rate cut will have a big impact on the economy. But there definitely will be some people who are welcoming this and welcoming it in a big way, right? And I'm not just talking about Canadians with mortgages. I'm also talking about the federal government, right? First off, mortgage holders. Many people were hitting this mortgage renewal cliff. Maybe 50% of pre-COVID mortgages were set to renew in the next 6 months or something like that, or maybe over the next year. I can't remember the exact stat, but the concern was, okay, how much of a negative impact on the economy? How much less spending will there be when people are putting like 30% more of their income towards their housing because of these increased rates at renewal? So many Canadians saying, okay, thank God we're starting to lower rates now, because when I renew in 6 months, when I renew in a year, perhaps that shock won't be as extreme. And I think that's probably what the Bank of Canada is thinking as well. Okay, maybe we can lower this, have less of an impact, and we don't see this all of a sudden this incredible lack of growth in the economy from people not spending. But it's not just the mortgage holders that I think are going to be welcoming this. I think it's the federal government as well. You can think about however, obviously the Bank of Canada is supposed to be entirely independent from the federal government. At certain times, I'll be honest, I've questioned just how separated these organizations are. But you can think of that what you will. I think that this definitely helps out the federal government, because you might remember during the pandemic, they took on boatloads of debt, and that thought was, okay, we can take on this debt because rates are like 0.5% right now. It would be silly not to go into huge debt because of how cheap these interest rates are. The interesting thing is, even though they had the option to lock in that low interest rate debt for 20, 30 years by issuing those longer duration bonds, they instead issued far more of the shorter duration bonds to raise money for the government. Maybe like the 2-year, 3-year, 4-year, 5-year sort of range. Maybe they only have 2 and 5. But this helps out the government a lot too, because just like mortgage holders, they're going to have to renew as well. Right? They don't have any prospect of paying off this debt that they've taken on, so that always means they have to refinance that debt by issuing more bonds at today's prevailing interest rate. So that'll make things a little bit more cheap for them, and maybe a little bit less pressure on the federal government when it comes to their increases in spending, as it gets slightly cheaper for them, or at least feels like it will head in that direction over the next number of months. So that's some impact for the government, for mortgage holders. What about for people who are investing, people who are in the markets? Well, generally, as interest rates go down, that usually tends to help out a number of higher risk investments, on the equities side, right? Companies will do better if there's lower interest rates, because people or businesses can expand more easily. They can take on debt to expand. Again, 0.25 percentage point, probably not going to have the biggest impact in the world, but again, this is more of a directional change. And what will this impact, along with the other rate cuts that we're projecting will happen over the next year? How will the aggregate of all of those impact the Canadian economy? That's what we're really talking about right now. It's not just this one individual rate cut. So usually that helps out businesses and their stock performance as well, if they can take on debt more cheaply. Obviously, lower interest rates means more people want to spend. That's good for businesses. More people buying their products, the more people buying their services. So when it comes to your stocks, you can sort of think of this as a good thing for that value. Of course, we're going to see some sort of impact on the real estate market. Usually lower rates mean higher prices, so maybe we'll see that over the next 6 months in real estate. But to the extent to how much this changes things in the real estate market, again, remains to be seen. They talk about this pent-up demand and all these people that want to buy homes. Will this be enough for them to now afford it and now qualify, even with the mortgage stress test? I think that people that could have qualified before are largely the only people who can qualify now. The question is, are those people who could have qualified but didn't want to because of the high rates, are they now going to say, okay, I'm going to jump in now to try to get ahead of the game of these interest rate decreases, right? That's the big question. But yeah, generally when interest rates come down, people need to go farther along the risk curve to get their return instead of just sitting in a high interest savings account getting 4%. Well, as the Bank of Canada's rates come down, people can't offer that anymore. That means people look to other places to get their returns. They look to investing in equities, yes, but also things way farther out on the risk curve like crypto. I talk about my interest in Bitcoin and Ethereum. People will go even farther than me on that. But generally, lower interest rates are good for those types of high risk assets. So do with that information what you will. Nobody has a crystal ball on what happens, but that's just the way that I'm thinking about things. So yeah, that's a lot of what's going on here. Yeah, I've seen a couple people in the chat talking about like, okay, well, I'm not seeing prices go down. Sorry, you're never going to. Yeah, I don't think you're ever going to, unless we see deflation, which is a whole nother issue. But yeah, bringing back inflation to 2% doesn't mean that we go back to yesterday's prices. It just means that prices continue to go up, but at a 2% rate, at a slower, maybe more manageable rate for average Canadians. So who knows? Maybe this is something that's going to help to keep CPI the same. I don't think that a quarter point cut is going to re-spark inflation, though, personally. Who knows, though? Yeah, a couple of questions here from the chat before we call it here for the day. Thank you again for joining me. Subscribe to the channel if you haven't already done so. You can get all the sources for the videos that I do by joining the mailing list down there. Also, I tend to be kind of critical of the government, so if you haven't already joined that mailing list, it's a good idea to do so because I'm not so certain that I'll always be able to have the platform that I have on YouTube. You never know when you say some controversial things sometimes. So join that mailing list. It's great to see all the people that are already on there. BA says, keep interest rates where they are or your kids will suffer with them. Debt is the real topic. Thanks. I think you have good insight. I appreciate it, BA. If prices don't go up, you don't need more money. Almost, yeah, Matthew Semenek, almost at the 100,000 play button. That's been a long-term goal, so that would be cool. Maybe in the next year or so. We'll see. Big Boy Baloo says we need to go back to pre-1979 and step away from the IMF. Yeah, a lot of questions about these sort of globalist organizations that kind of try to coordinate multiple countries together. I have questions about the sort of centralization of power amongst those organizations and to what extent do they sort of vet the different political leaders in different countries. Again, some stuff that maybe a lot of people don't like to talk about, but I am at least curious about. Wayne saying, love the channel, always true facts. I appreciate it, do my best. You says, now the house prices are not coming down, almost guaranteed. The message is clear from the government. Good luck, first-time home buyers. Yeah, that's kind of how I feel about it too. It's like there's all this talk about affordability, all this talk about we're going to build more houses so that houses are affordable and first-time buyers can get in. And I think that's great for getting votes. If you can convince people that you're going to do something on housing, you're going to get a ton of votes. But I think the best thing for a political party to do, for them to not only get the non-homeowner votes, but to get the current homeowner votes, is to talk a whole hell of a lot about how much you're going to help housing, how you're going to make it more affordable. But then, like we just saw Trudeau do, saying, well, actually, we can't have house prices come down because that's people's retirement accounts. I think it's saying you're going to do something, but not actually doing it is probably the best thing you could do as a political party to get the most votes from both sides, both homeowners and non-homeowners, right? If you think about it, convince the non-homeowners you're going to do something, don't actually do it, and then all the homeowners kind of know that you're not going to follow through with it. That's the interesting stuff here. Like, and we look at similar stuff with the capital gains tax change, right? They talk, okay, we're going to make all these differences. We're gonna tax the wealthy. Newsflash, I guess now the wealthy are just anybody that has a cottage. Period. Any boomer who has a second property, you're the wealthy people that we've got to eat the rich, we've got to eat grandma and grandpa who have saved up and had a rental property. That's wild. But yeah, they talk about it and then don't implement it. It was in the budget. We're not seeing that legislation actually come through. So people are convinced this capital gains tax thing is happening, and I've talked about it on the channel as if it was as well, but they never brought the legislation. The House of Commons is supposed to go on their summer break starting June 25th. Will it actually ever happen? Maybe they're saving it for like a campaign promise or something. Yeah, wild stuff. And I think I get more and more skeptical each day. So bear with me if I ever sound negative about this stuff. But as I always say on this channel, I'm not an expert in this kind of stuff. I don't know everything that's going on. But just like you, I'm trying to put all the pieces together and sort of share what I find out along the way. So always interested in what you think and what things I'm missing, what things I'm right on, what things I'm wrong on. And I appreciate you subscribing and following along with this journey as I try to figure out what the hell is even happening. And I have no clue most of the time. I don't know about you. But with that, I think we're gonna call the stream there. I appreciate you being here with me. Interesting stuff seeing the Bank of Canada cut interest rates by 25 basis points, 1/4%. We're going to have to see in the coming months, what does this do? Subscribe to the channel. I'll be talking all about it and all the different things that happen in this country and maybe even outside of this country as we move on over the next few months. So with all that said, thanks so much for watching, everybody. Hope this stream has helped you out at least a little bit, and I'll see you next time.